Welcome to EKO201E Economics. I'm Chris Hannum. This is lecture 11 on firm behavior in perfectly competitive markets. This is the logical extension of the previous lecture on costs of production. If it didn't make much sense when we were talking about cost of production, what all of these costs were for, you'll see the applications here as we discuss firm behavior in competitive markets, why we went to all that trouble to define them. We mentioned back in the discussion on supply and demand what exactly it meant for a market to be perfectly competitive, and we also mentioned that a perfectly competitive market is an extreme case, not necessarily going to be a very accurate representation of most real markets for most real products you can think of. But first we build a model of this relatively extreme case, and then in the next lectures, as part of this 5-lecture unit on firm behavior and market structure, we'll talk about how making small changes to those assumptions of perfect competition give us different outcomes for our way that the market allocates resources and makes these economic decisions. Again, what we mean when we say a market is perfectly competitive, as we said before, that market should have many buyers and sellers, maybe a huge number, arbitrarily many buyers and sellers, nearly infinite number of buyers and sellers. And it should be the case that every single good for this market is identical, so that buyers don't differentiate between the tomatoes or the potatoes or the crude oil or the electricity that one buyer is producing. And they aren't potentially willing to pay more for one person's tomatoes or one company's electricity than they would be willing to pay for somebody else's. We mentioned those two assumptions are necessary for a market to be perfectly competitive. It's also necessary that each and every buyer needs to know what each and every seller is charging. We need to have perfect information about what things cost. And we also, as we did something we didn't mention before, we need in the long run to have free entry into the market and free exit out of the market for businesses and consumers as well, but we're mostly concerned with businesses in this case. If we have free entry into the market, it means that while there might be only, say, 2,000 businesses producing these goods right now, if it became very profitable to sell them, we could see more businesses enter and have 2,100, 3,000, 4,000 businesses in that market in the future. If we have free exit from that market, then the fact that we have 2,000 businesses in that market right now wouldn't mean that we would necessarily have 2,000 next year if it was very unprofitable to be selling these goods in this industry. If it was very unprofitable, some of these businesses might choose to shut down. They might choose to leave the market. And for our market to meet these assumptions for perfect competition, it has to be very easy for them to enter, and it has to be very easy for them to exit. Now, next to note, we mentioned back in the context of supply and demand that the reason these assumptions are important is because we want in a perfectly competitive market each and every business and each and every buyer, each and every consumer to simply see a market price and make their decisions accordingly. We want them to be price takers rather than price makers whose decisions aren't influenced by any attempt to manipulate that price. We'll get into later chapters, later lectures where we talk about less competitive market structures, situations in which buyers or sellers could do that. But here we want to assume that they can't and they don't. All businesses are price takers, as are all consumers. Next, we have to again define a few terms because now we want to add a revenue side to the cost side that we presented in the previous lecture for the firm, which informs the decision-making process of that firm. We said total revenue for the firm was the price that they charge times the quantity of output that they produce. That's total revenue. Average revenue, therefore, would be total revenue, the price that they charge, times the quantity that they produce, divided by the quantity that they produce. That would be their average revenue. That firm's marginal revenue, as they increase the quantity that they produce, would be the change in total revenue. Now, If we assume that all businesses are price takers, then the price is a constant. It's something they see but can't change. And if they increase their quantity of output by 1 or 1 million, the price in that market wouldn't change. So if the price is just 10, then their total revenue is 10 times Q. And their average revenue is 10. It's 10 times Q divided by Q. And their marginal revenue would also be 10. Anytime we increase that Q by 1, total revenue, 10 times Q, would increase by 10. So this is the case only for firms in perfectly competitive markets because they can't affect the price. They're price takers. For these firms, and only these firms, average revenue is equal to the price, and marginal revenue is also equal to the price. Note that wouldn't be the case if changing the quantity of output by, say, 1 million caused the price to change. But here we're assuming that it doesn't and it can't because of these assumptions of perfect competition. Now, we want to relate this again. The point of this whole exercise is for describing the way in which we model business decision-making in economics. Businesses, we would imagine, are trying to find the quantity of output for this output decision that would maximize their profit. Where would their profit be as high as it could possibly be? So they would be factoring in first the marginal revenue that they would get for selling one more unit of that product. And if that market is perfectly competitive, so the firm is a price taker, that marginal revenue of making and selling one more unit of output is the price. And they would compare that to the marginal cost, which we talked a lot about in the previous lecture, of producing that unit of output. And if they see that the price, the marginal revenue, is greater than the marginal cost, then they would choose to produce that unit of output because it would cause their profit to rise. Anytime marginal revenue is greater than marginal cost, producing that unit of output would cause profit to rise. So we would imagine that business, at any point where they see that marginal revenue is greater than marginal cost, should see this and increase the output that they produce. And they should continue to increase the amount that they produce, making these decisions at the margin, continually comparing marginal revenue and marginal cost until they find that they're producing a quantity of output for which marginal revenue is not greater than marginal cost. On the other hand, if that business saw the opposite, they calculated marginal revenue and marginal cost for some quantity of output, and they saw that marginal revenue, or here for a perfectly competitive firm, the price was less than their marginal cost. Then by producing that unit of output, they would cause their profit to fall. It would have a negative profit margin on that marginal unit of output. And they should choose not to produce that unit of output. Or they should see that and choose to produce less. And they should continue to produce less and less and less as they continue to reevaluate, compare marginal revenue and marginal cost, see that marginal cost is higher than marginal revenue, until marginal revenue and marginal cost are now equal. And at that point where they're equal, then the company wouldn't be able to increase their profit by increasing the amount that they produce, and wouldn't be able to increase the profit by decreasing the amount that they produce. As you can see in this table, on this slide for profit maximization, as we plot out all of the total revenue, total cost, profit, marginal revenue, and marginal costs for this firm, given different quantities of output, we can look at how profit changes as they change the quantity that they produce. Their profit, if they choose to produce 0 units of output, would be total revenue of 0 minus a total cost of 5 or a loss of 5. If this firm chooses to go from 0 units of output to 1 unit of output, their change in profit is the difference between their marginal revenue of the first unit and their marginal cost of the first unit. Their marginal revenue is 10, their marginal cost is 4, so their profit increases by 6. That is, it goes from -5 to +1. So their increase in profit is 6. So their marginal profit of the first unit, their profit margin is 6. As they go from 1 unit of output to 2 units of output, again, their marginal revenue is 10 because the marginal revenue is equal to the price, which is constant. It doesn't vary with the quantity of output that they produce. But their marginal cost now goes from 4 to 6. So their profit increases by only 4. Now, should they produce 1 or should they produce 2? Well, their profit is increasing when they produce the second unit. Their total profit is higher than it was before. We wouldn't imagine that a business tries to maximize a profit margin, or a business tries to maximize a marginal profit per unit. We'd imagine a business wants to maximize the total profit. And the total profit is higher with 2 units of output than it is with 1. And then if they choose to produce the third unit of output, again, revenue rises by 10. Marginal revenue is 10. That's equal to the price, which does not change as the quantity of output increases. Now the marginal cost goes from 6 to 8. So their profit increases by 2. Now the profit increases, so it's still worth producing. As they increase their output from 3 to 4, now the price is 10, marginal revenue is 10, but now marginal cost is also 10. So as they go from 3 to 4, their profit does not increase. It stays the same. It doesn't fall, but it stays the same. Now marginal revenue and marginal cost are the same. If they were to produce a 5th unit instead of 4, their price, their marginal revenue would remain 10, but now their marginal cost of the 5th unit is 12. And the change in profit associated with that 5th unit is negative 2. Their profit would actually fall if they were to produce 5 units as opposed to 4. So clearly producing that 5th unit is not worthwhile. It does not cause profits to rise. The profit maximizing quantity of output in this case, we could say is 4. We could also say is 3, as we've calculated it right here. But we assume that a business is going to want to produce up to the point where marginal revenue is equal to marginal cost. We could imagine that first, the way in which they operate is to see that at a production quantity of 3, marginal revenue is still greater than marginal cost, and react to this by producing more, and not stop producing until they see that marginal revenue is no longer greater than marginal cost, which they see at a quantity of 4. We could also imagine that if a business doesn't lose any money by producing, it doesn't cause profit to fall, they would prefer to keep customers happy by producing more. If we want to plot this information out in 2-dimensional space using quantity on the horizontal axis and cost or price, something monetary on the vertical axis, we can plot out our marginal revenue for a competitive firm. That is the marginal revenue for the first, second, 5th unit. And it's always constant, at the same value for price, the same value for money on the vertical axis. So it's a horizontal line. And that marginal revenue would always be a horizontal line for businesses in competitive markets. And then we would also plot out that marginal cost for the firm, which, as we demonstrated in the previous example, is often going to be rising as they produce 1, 2, 3, 4 units. And we plot out all of those points and create a marginal cost curve which connects them. And then we can see that there's exactly one point where those two curves, the marginal revenue curve and the marginal cost curve in this 2-dimensional space, intersect. This is the single point where marginal revenue and marginal cost are equal, which, as we said in the previous example, was a quantity of 4. Now, this would be the single point if we imagine that this firm is going to produce some large quantity of output or produce some continuous scale of output, not just 3 versus 4, but some number of, say, grams, or produce some quantity ranging in the millions. They would want to produce up to exactly that point where their marginal revenue and marginal cost are exactly equal. And if they did that, then their profit would be as high as it could possibly be. Because up to that point, for all quantities up to this Q1, or for in the previous script, all quantities up to 4, the gap between marginal revenue and marginal cost is positive rather than negative, marginal revenue minus marginal cost, and profit increases as we move right along our curve and increase our quantity of production towards Q1. Profit, on the other hand, would decrease if we were to produce more than that Q1 and continue to move on right past that point, past that profit maximizing point. Now, what we want to focus on is the relationship between these marginal costs, marginal revenues, and the firm's quote-unquote supply decision. That supply decision or quantity decision is the decision that we imagine that firm must make about what quantity of output they should produce. And many of the other decisions that these firms need to make are derived directly from that quantity decision, such as a hiring decision, a rental decision. Those kinds of decisions are indirectly determined by a decision on quantity. Say this firm would choose to produce any unit of output for which marginal revenue was greater than marginal cost. And that would be the efficient quantity of output for them to produce, the optimal quantity of output for them to produce. In this example, Q1. Now, if we were to increase the price in this market, and again, we say that this firm is a price taker, they don't have any control over the price, but that doesn't mean the price could never change. Maybe something affected the demand for these products, causing people to be willing to pay more. If we imagine that for whatever reason, price rises suddenly from P1 to P2, then there are units of output that this firm wouldn't have considered to be worth producing because marginal cost was too high relative to marginal revenue that now are worth producing because marginal revenue and price have risen. So now after the increase in price from P1 to P2, this firm decides to increase the quantity that they produce from Q1 to Q2. So higher prices lead firms to choose to produce more. Lower prices lead firms to choose to produce less. As you can intuitively grasp, this is very much like what we said should occur in the supply relationship, along the supply curve. As we change the price, that price should determine a quantity supplied. And quantity supplied is the quantity that we're talking about on these marginal cost curves. Because a marginal cost curve fundamentally is basically the same thing as the supply curve for an individual business. But there's one key difference. We'll get into that key difference later when we discuss another decision, another key type of decision that a business needs to make. The next key decision that we want to discuss for a business in a perfectly competitive market is referred to as shutdown. Now, we imagine a business has the ability to decide whether they should produce 0 or 1, 2, 3, 4, some other non-zero quantity of output. And we imagine that if they decide to produce 0, they could avoid all variable costs, but continue to pay fixed costs. And then the next decision that we'll look at after that is what we call the exit decision. A shutdown decision is a decision to produce 0, but continue to exist. And it's a short-run decision because it assumes that some costs are fixed. Now, the exit decision is a long-run decision because we assume that businesses cannot exit in the short run. That is, they cannot exit because they must continue to pay some fixed costs. They have maybe contractual obligations to continue to pay rent for a further 12 months. So they can't exit the market in any real sense, even if they decide to shut their business and produce nothing and sell nothing. We'll look at how businesses in perfectly competitive markets should be making these decisions. To note, one key difference between these decisions of shutdown in the short run versus exit in the long run is that in the long run, no costs are fixed. So in the long run, when a firm exits, its profits will be 0, necessarily. It won't lose anything because it doesn't have to pay any cost of any kind. However, in the short run, if all a firm can do is shut down instead of exit, this would lead to negative profit, zero revenue, but still potentially high fixed cost. Now, how would a firm make this decision in the short run about whether or not to shut down? Well, if a firm shuts down, that firm would still have to pay fixed cost. So for them to prefer to shut down rather than produce some other quantity of output, the best other quantity of output that would give them the highest profits or the smallest negative profits, smallest losses, must be even worse than shutting down, producing nothing, and paying fixed costs and bearing those losses. So what this firm would look at is at that point, which was optimal, where marginal cost was equal to marginal revenue, which is the best they could potentially do if they didn't shut down, to compare their losses, assuming they're making losses, when producing that quantity of output, to their losses if they were to produce nothing and pay only fixed costs. If their average variable cost, which is what they can avoid by shutting down, if their average variable cost is very high, and average variable cost at that optimal quantity of output, average variable cost is higher than the marginal revenue or the price, that's when a firm would decide that it simply wasn't worth producing any quantity of output because their average variable costs were too high. And if their average variable costs were too high, they would prefer to have zero variable cost by producing zero and continuing to pay fixed cost. So we look at that point which the business chooses to produce, which is not changing here, the point which they would choose to produce if they did decide to produce some non-zero quantity of output, it would still be defined by where marginal revenue is equal to marginal cost. If at that quantity of output, where marginal revenue is equal to marginal cost, is average variable cost greater than the price, or is it less than the price? Now also to note, for the shutdown rule, average variable cost is minimized where average variable cost is equal to the marginal cost, just like average total cost is minimized where average total cost is equal to marginal cost. Now, if we look for that, plotting our average total cost, our average variable cost, our marginal cost on a single curve, and we look for what range of prices on this curve, that is, price and cost are both grouped on this vertical axis, monetary axis. What range of prices would lead this business to decide not to produce any output? Note that this business would choose to produce, if they were to produce some quantity of output, where the price was equal to marginal cost. And there's some range of prices where marginal cost is very low relative to average variable cost. That's all of those quantities, all of those prices before the point where average variable cost and marginal cost intersect. For those quantities, a business chooses to shut down and chooses to produce nothing. However, for all other prices that are greater than that price, that business would choose, instead of shutting down, even if they're making some losses, because our price might still be less than average total cost, they would choose to produce at that quantity where price was equal to marginal cost. So all of those values, all of those combinations of price and quantity on our marginal cost curve, they become the firm's short-run supply curve. But that portion of the marginal cost curve with very low prices is not part of the short-run supply curve because the firm would not be willing to produce anything at those quantities. So that's the fundamental difference between the marginal cost curve for the firm and the firm's short-run supply curve. Next to mention one other type or definition, concept of a cost we haven't talked about yet, we'd call a sunk cost. A sunk cost in economics is a term that refers to a cost you can't avoid And because you can't avoid it, usually you've already paid it, you shouldn't factor it into your decisions at all. It's too late to do anything about it. In the case of the shutdown decision, that shutdown decision should be made irrespective of how high fixed costs actually are. We should be considering only our variable costs. If we want our losses to be as small as they could possibly be, if our losses are as small as they can possibly be while we still pay potentially enormous fixed costs by shutting down, the fact that those fixed costs are enormous and we already paid all of those fixed costs shouldn't actually do anything to influence our decision to shut down. That money is already paid. It can't be recovered. There's nothing we can do to get it back. If it's optimal to continue to pay it and not receive any revenue because the variable costs would just be so high, that's exactly what we should do. There may be other cases in which other types of sunk costs, unavoidable costs, do influence real people's decision-making, but economists argue that they really shouldn't. And if they do, people are falling prey to what we call the sunk cost fallacy. The idea that these costs are important because, of course, they do determine partly what our profit is. They may be things that we regret, but if we can't change them, they shouldn't factor into our decisions going forward. Next, what we want to look at is a firm's long-run decision as opposed to its short-run decision. In a long-run decision, these costs are no longer fixed, they are no longer sunk, and they are no longer irrelevant. On the long run, a firm could choose not only to shut down and produce zero, but could avoid all of these fixed costs, because all costs in the long run are variable, if they choose to produce zero and leave the market entirely. So when would a firm choose to exit? We've already established that if a firm exits, so this firm's no longer in the market at all, then the firm's profits will be zero. There are no profits, there are no losses, there are no revenues, there are no costs if this firm leaves the market entirely. So if the firm leaves the market entirely, they'll necessarily have a profit of zero. And if that profit of zero is the best that they can do, because there's no way when they choose some other non-zero quantity of output for them to get a positive profit, then that's what they should do. They should choose to exit if the best they could do otherwise is, say, a -5 profit, a loss of 5. Or if the best they could do otherwise is a -5 million or -5 billion, 5 billion loss, then they should exit as opposed to continuing in that market. Now that assumes that this business believes that this situation is permanent, that the best they can do right now might be a 5 million loss, and the best they can do at any point in the future, they have no reason to believe will be anything different than a 5 million loss. And rather than continue to lose 5 million every year, they should certainly prefer to exit, to cease to exist as a business, or perhaps switch to producing a different product, move to a different market, or to close down this business, open another business instead. Now, this firm should decide to exit in this case whenever their profit at that point, their marginal profit at that point where they're maximizing their profits by producing where marginal revenue equal marginal cost, they should exit the market if at that point price is still less than average total cost. We established there were some range of possible prices on that graph as we drew it a minute ago. There's some range of possible prices where the firm is losing money. Their profits are negative, but average variable cost was still less than the price. And for all of those prices, and for the quantities associated with those prices, a business in the long run should still exit because they're still losing money. They still have negative profits when the price is so low. They should only be willing to produce some quantity of output, to be willing to exist as a firm in this market, if the price were to rise at least above that minimum average total cost. If it's above that minimum average total cost, then there would be some level of output that would lead to positive profits. But if the price is below that minimum average total cost, there would be no level of output that could potentially lead to positive profits. And note that that minimum average total cost, again, comes exactly where average total cost is exactly equal to marginal cost. Whereas the shutdown decision doesn't have any mirror. The exit decision does. The exit decision is mirrored by the potential decision to enter the market by a business that isn't currently producing that product or by a business that doesn't currently exist at all. They could decide to enter that market if all of those businesses currently in the market were earning positive profits. So the price was high relative to average total cost at that quantity that those businesses were deciding to produce at, where marginal revenue and marginal cost were equal. Now, if some business that isn't currently producing that product or some business that doesn't currently exist sees that all of the businesses in an industry are profitable and they believe that they could be exactly like those businesses, producing at the same scale, with the same technology, paying the same costs, we make that assumption, then there's no reason they wouldn't want to join in and get some of those profits that those other businesses are getting. So long as we have a price that's greater than average total cost, or here, a price that's greater than minimum average total cost, we would expect some businesses to want to enter that market. That would define their entry decision, just like the opposite side defines their exit decision. So in the long run, we can also define a supply curve for a firm, just like we could in the short run, as this range of price and quantity combinations where the firm wouldn't choose to produce nothing. They wouldn't choose to exit. So it would be all those points on our marginal cost curve which have prices that are greater than minimum average total cost. Because for all of those prices, the firm would prefer to produce something, that quantity, on the marginal cost curve, instead of producing nothing and leaving the market entirely, exiting. So all of those prices where the firm would choose to exit, they're not part of the firm's long-run supply curve, even though they are part of the firm's marginal cost curve. That's the difference between the marginal cost curve and the firm's supply curve in the long run. Note, there's a range on that short-run supply curve, which doesn't factor into that long-run supply curve, because the firm would choose to shut down only if the price were to be extremely low, but they would decide to exit for a range of real prices where they would not choose to shut down. Now, next, if we can identify what the price is, what the marginal cost is, and also what the average total cost is for the firm, plot those on the same graph, we can determine first where this firm will choose to produce. It will choose to produce that quantity where marginal revenue and marginal cost are equal, or where price for a perfectly competitive firm and marginal cost are equal. We can also define how profitable this firm is. So on this graph, take a look at that point where the firm chooses to produce, where this horizontal marginal revenue crosses the upward sloping marginal cost curve. And at that quantity, what's the gap between the price and the average total cost? That's the profit margin on average per unit. And they're producing this 50 units, some quantity, optimal quantity of output. So we multiply that profit margin, in this case, the gap between a price of 10 and an average total cost of 6, profit margin of 4, by the 50 units that they produce to get a rectangle on our graph where that area represents total profit. Of course, that firm will be profitable so long as at this quantity, the price is above the average total cost curve. How high above it is defines what the profit margin is, or how profitable the firm is. Here, the profit is earning, a profit for this firm that it earns is equal to 200, or 50 times 4. Next, we're going to assume the same scenario, or a similar scenario, for the same firm with the same average total cost curve, the same marginal cost curve, but now suddenly weak demand for their product in the entire market, leading to a low price that they're able to charge for that product. Again, we assume this firm is perfectly competitive, so they see a price in the market and they simply have to react accordingly. They can't cause the price to become 10. Nothing that they did caused the price to become 3. But that doesn't mean that nothing in the market changes or fluctuates, leading to changes in the price. It's just that this firm can't do anything to change the price. They're a price taker for whatever the price currently is. But we assume the price is only 3. In this case, suppose the firm chooses to produce this optimal quantity of output, which is where the price, marginal revenue, intersects marginal cost. And in this case, that optimal quantity of output is 30. But we can see that if this firm does produce 30, then their average total cost is 5 with a price of only 3. So now their profit isn't 2 times 30. Their profit is a negative 2 times 30. It's 3 minus 5 times 30. Because this firm is earning a negative 60 profit, this firm should choose to exit if they don't believe that anything is likely to change about this market in the future. So this very low price of 3 is likely to remain. If they hope that next year the price will rebound to 6, they might not choose to exit. We're assuming that they expect it to remain 3 forever. Now, what we've focused on so far is an individual firm's output decision, and an individual firm's shutdown decision, and an individual firm's entry and exit decisions. What we want to do is to carry this over to an explanation of how the entire market supply will be derived from these decisions that individual firms make. So we're going to assume first all firms that exist and all firms that could exist are identical. Now, this is just for simplicity's sake, because we don't want to have to get into an explanation of how they might be different or what the importance is of their differences, just for assumption. We'll imagine hypothetical firms are exactly the same as one another. And next, we'll assume that firms' costs don't change based on decisions that other firms make. So if one firm enters the industry, existing firms' costs remain the same. They don't have to pay their workers more because some new company has entered the market. Or it doesn't increase their rent because of competition from buildings for new entrants into this market. This is an unrealistic simplifying assumption, but we don't want to have to here get into, for our example, what the impact exactly would be if we had one more business enter the market and how that would change their decisions. For simplicity's sake, assume their costs don't change when we have entry and exit from that market. And assume that we have one assumption in the short run that both firms have fixed costs, but also the number of firms is fixed. So if we have 10 firms in the short run, we cannot have an 11th because no one can enter, and we cannot have 9 because no firm can exit. Assume that in the short run, a firm that does not want to produce any output could shut down, but they can't exit, they can't leave the market entirely. And if there are a lot of profits to be had in the short run, it's still not possible for any firms to enter. But we make the long run assumption that firms can enter and that they do so costlessly. It's very easy for them to do that based on our assumptions of perfect competition. And we assume that in the long run, firms can exit, and they can do that costlessly. So in the long run, the number of firms is variable, but in the short run, it's fixed. We'll get into exactly how we determine what the number of firms is likely to be in the long run when it becomes variable. Now, to define those short-run supply decisions, we said that short-run supply curve was the individual firm's marginal cost curve for all of those prices and therefore levels of output where the price was greater than minimum average variable cost. Now, if we have a fixed number of firms, then for each of those prices, we have a supply curve for the firms that do exist, showing the quantity that they would supply. And in the short run, we can get market quantity supplied just by summing up all of the quantities supplied at each price by each of the firms that exist. If we have 10 firms, we sum up the quantity that each of those 10 firms would be willing to supply at a price of 6, 7, 8, and so on, and that becomes market supply. Now, if we plot out here our short-run market supply curves, as they are derived from and defined by the supply curve for one firm, that one firm we graph along with an average variable cost, and that average variable cost shows the price, and therefore the quantity for the single firm, in this case 10, below which they would not be willing to produce anything at all. Now on the market level, over to the right, we don't have an average variable cost expressed for the market. We have a marginal cost, because the marginal cost is the cost to the next producer, not just the next level of output to the same producer. And that quantity at which that firm would just barely be willing to produce, because it went along with a price such that the firm would just barely be willing to produce something non-zero and not shut down, here being 10. If we have 1,000 firms in the market, it becomes 10,000 at that exact price of P1. So for the market supply, below a price of P1, the market is not willing to produce anything because every firm, assuming they're identical in this market, simultaneously shuts down if the price is below P1. But if it rises to at least P1, the quantity that the market produces becomes 10,000. For the individual firm, if the price were to rise to P2, then that firm, finding that point on their marginal cost curve, with price P2 would be willing to produce 20, meaning the market as a whole, made up of 1,000 identical firms, would produce 20,000. If the price were to rise further to P3, then that individual firm, finding the point on their marginal cost curve, with price or cost equal to P3, would be willing to produce 30, and 1,000 identical firms would produce 30,000. So all those points, connecting those points, gives that market supply curve, just equal to the sum of the supply curves for the individual firms in the short run. Now in the long run, the number of firms that we have isn't fixed. The number of firms that we have varies, and it varies depending on whether or not firms are profitable. So if firms are profitable in the short run, then we would expect, as we move to the long run, that the number of firms will increase through entry, and the number of firms would continue to increase until firms were no longer profitable. Now, we would also assume that if firms in the short run had negative profits, but they didn't shut down, they had negative profits, as we move to the long run, we should expect exit. Incremental exit by one firm, two firms, three firms, and that exit would continue until the firms were no longer earning losses. So for us to have some kind of a long-run equilibrium number of firms, it must be the case that no firms currently in the industry want to leave, and no firms that aren't currently in the industry want to enter that market. And that can only come about if these firms are not earning either positive or negative profits. Also to point out, if we're comparing short-run supplies and short-run markets, as we have firms leave, because remember, each short-run supply curve goes along with a specific number of firms. Each additional firm that enters, since the short-run supply curve for the market is just the sum of the short-run supply curves for an individual firm, each firm that enters shifts the supply curve out. And each firm that exits, if firms want to exit because firms are earning negative profits, each firm that exits would shift in these short-run supply curves. We could have a smaller number of firms, and the market supply curve is just the sum of all the individual firms' supply curves. So as we have entry, we shift out market supply. As we have exit, we shift in market supply. And as we move to the long run, we would assume that if firms are earning positive profits, then market supply would continue to shift out until firms were no longer earning positive profits. And market supply would continue to shift in until firms were no longer making losses. So we would have a market supply curve which wasn't specific, not clearly defined as it is in the short run. In the long run, we must have the market supply curve which is defined by profitability. And it would be defined by finding that quantity of output for each of those individual firms, where those individual firms are just barely breaking even, and the price for those individual firms, where the price is equal to marginal cost and average total cost together. Because that's the only price and only quantity that together are consistent with zero profitability. And here, zero profitability is a necessary condition for us not to have any more entry and not to have any more exit. We would refer to this point. So this outcome in the long run in a competitive market, where no firm is profitable, therefore there's no entry or exit, as a long-run equilibrium. It's an equilibrium because there's no inherent tendency based on the logic of that market to move away from that equilibrium. In a sense, we talked about supply and demand equilibrium, meaning a specific price and a specific quantity where there's no natural momentum away from that price. That price is at rest. And there's no natural momentum away from that quantity. That quantity is at rest. Here, for us to have a long-run equilibrium, we don't just need a price that's at rest and a quantity produced that's at rest. We need a number of firms that's at rest. That means we can't have a long-run equilibrium if we have more firms that want to enter this market or firms that are currently in it that want to exit. And the only combination of price and quantity, etc., that are consistent with this is where price is equal to average total cost and price is equal to marginal cost because it's a perfectly competitive market. Therefore, marginal cost is equal to average total cost. Marginal cost is equal to average total cost only, once again, at that point where average total cost, which is U-shaped, is minimized. It intersects the marginal cost curve at its minimum. Now, so in the long run, in a competitive market, this gives us the outcome that price equals minimum average total cost. Because price equals marginal cost, which equals average total cost, and only equals average total cost when average total cost is minimized. And this result is huge. What we talked about in many cases already from one of those principles of economics is that markets are usually a good way to organize economic activity. And we talked about, in the case of welfare economics, the idea that total surplus may be maximized, that consumer surplus and producer surplus combination is maximized at that particular price, which we like. Here what we're saying is that when markets organize economic activity and markets are perfectly competitive, this is critical. When markets are perfectly competitive, price that we see in that market at equilibrium is equal to minimum average total cost. And all firms produce with minimum average total cost at the quantities that they actually choose to produce. So we have minimum average total cost, not average total cost of production, which is higher. And that means that if we have a perfectly competitive market and the market organizes economic activity, then we wind up with a very efficient economy that's actually utilizing resources efficiently and producing as much as we could possibly produce. So imagine we had some alternative way to organize economic activity such that businesses were not producing at that point where average total cost was minimized. Our whole economy would not be able to produce as much stuff because the cost to produce it in terms of resources used would be so high. So our economy is as efficient as it can possibly be. The cost of all of the goods that we buy, the price that we pay for all of those goods that we buy, is as low as it can conceivably be if we have a perfectly competitive market and we allow that perfectly competitive market to organize economic activity. Now, to clarify something which is confusing and counterintuitive for many students of economics is the idea of zero profit. Actually, this zero profit condition is what we assume determines whether or not firms enter or exit that market. We say they will enter as long as profits are greater than zero. And intuitively, people wonder, why is it that a firm would want a very small profit? Why is it that they would continue to even exist if the profit was zero? And remember that we mean something very specific when we say profit in economics. We mean this economic profit. And that economic profit factors in not only explicit financial costs that the business is shelling out money for, but also implicit costs. That's the cost of using the inputs that they own for this business purpose as opposed to some other purpose. Maybe selling them, maybe renting them out. And that means that for all of the capital that the business has and owns, they have an implicit cost of continuing to use it instead of using it for some other purpose, selling it, renting it. And all this means in the end is that all businesses should have roughly the same profit margin. That is, their capital that they use, be it financial capital, property capital, should be roughly as profitable or roughly as efficiently used in this particular business purpose as in some other potential business purpose. And if it isn't, the business could potentially be earning a positive accounting profit by using a lot of property that they own, using a lot of machinery that they own, using a lot of financial capital that they own. But because all of those resources could have been put to a better use and earning more accounting profit, earning more return somewhere else, they would have been more efficiently put to those other uses. And if a business is making these decisions based on an economic profit calculation, they would see that using those resources themselves, although it led to a positive accounting profit, actually led to a negative economic profit. And they would be better off, say, selling the assets that they use for a relatively high return, or switching to another product market where they could get a higher return on the capital that they're using, because it isn't best used in this particular purpose. So when we say that a business earns zero profit in this long-run equilibrium, this is zero economic profit, but this does go along with a positive accounting profit. So when you read financial statements of these businesses, you may hear that they are earning 5 billion, 10 billion, potentially huge accounting profits, because these businesses own a lot of capital which they use. It can be intangible or physical capital. Also, when they're making zero economic profit, they're still able to pay all of their costs. It's not the case that a business is unable to do so. Next, what we want to talk about is the firm's long-run market supply curve. Now, the market supply curve is determined not just by individual firms' supply curves, because in the long run, we could have many of them. We can't say for sure whether we're going to have 999 or 1001. We can't simply sum up all of the individual firms' supply curves to get the long-run market supply curve. But if we do have one firm, and that one firm, we can illustrate there in two-dimensional space, that long-run average total cost curve and that marginal cost curve, we can show where those two intersect. And say for that individual firm, at that particular point where long-run average total cost is minimized, at that particular point, that firm would not want to enter or exit that market. We've established that our long-run equilibrium should have a price equal to that exact price, because that price is the only price that's consistent with firms no longer wanting to enter the market and no longer wanting to exit. Because while an individual firm can't influence or control the price, trends in market supply do shift long-run equilibrium, and the price will change when we have many firms enter. The price will change when we have many firms exit, because we're shifting market supply. But we assume that firms that are making these entry decisions don't think that far ahead. Or firms that are making these exit decisions, they don't think that far ahead either. So our long-run market supply curve is just a horizontal line. It's a horizontal line at that price, where that price is equal to minimum long-run average total cost. And our market as a whole is willing to produce potentially any quantity at that price, because all that needs to happen for us to produce a much larger quantity is that we need to have firms enter that market. And those firms would continue to enter that market until we had a price equal to that price, if for whatever reason we initially had a price which was high. Next, what we want to look at is the impacts in the short run versus the impacts in the long run of some kind of a change in demand in our market. Now note, if we have a change in demand in our market, at the market level, that means a shift in the demand curve. At the market level, when we have a shift in that demand curve, an increase in that demand curve, what that causes is an increase in the equilibrium price. Now, the individual firm doesn't really see a shift in the demand curve, but the individual firm sees that the equilibrium price in the market rose. And that individual firm will react accordingly to the fact that the equilibrium price in the market rose. So the individual firm, if we have an increase in demand, therefore an increase in the price above this long-run equilibrium, which it might have been at before, that individual firm will choose to produce a bit more, and we'll see that when that firm produces that profit maximizing quantity, that individual firm is now profitable. You can see that rectangle right there with a base as the quantity that this individual firm produces, and the height being the difference between P1 and P2, between the original equilibrium quantity, which was equal to long-run average total cost, and the new equilibrium price, which is not. In that area, that positive profit, as we go from the short run to the long run, that change in the price leading to that change in the profit induces entry. So our immediate shock, shift out in demand at the market level, leads to an increase in the equilibrium price, leads individual firms to produce more, leads individual firms to be profitable. As we move from the short run to the long run, this causes a shift out in market supply. And that shift out in market supply will continue to occur as long as there are positive profits to be earned by the individual firm. And that shift out in supply also causes a drop in the equilibrium price, that point where the new supply curve intersects the demand curve. And for each additional entry into that market, the equilibrium price is going to fall. The equilibrium quantity is going to rise, but the equilibrium price is going to fall. And the only thing that an individual firm, like those firms that were in the industry already see, is that the equilibrium price now is falling due to entry into that market. They see this as increased competition. Increased competition driving down the price and driving down the profits that they were earning. As we move from the short term to the long term, the short run to the long run, and we have incrementally more entry into the market, that process of entry continues. There's several shifts out in the supply curve until that supply curve has shifted out enough that the supply curve now intersects the demand curve at a price which is equal to long-run average total cost. That's the only price at which firms no longer want to enter. So it keeps shifting out, slowly and incrementally until it reaches that point. And once it has reached that point, the equilibrium price has fallen and fallen and fallen on the individual firm's graph to the left, fallen down to a level where the firm's profits have disappeared. When those firms' profits disappear, you'll also note that that individual firm isn't producing as much quantity as they were after the initial shock to demand. So they initially responded by producing more, trying to meet that extra demand. And they only wanted to do that because the price was high. But as extra competition has forced down that equilibrium price, they're no longer interested in producing that extra quantity to meet that extra demand. All of that extra demand is being met by these new entrants into the market. Also note, when you carry that over to the market level graph on the right, that the market quantity supplied, the market quantity at equilibrium, is now much larger than it originally was. But again, all of that additional quantity supplied is coming from new entrants into the market. And in the end, in the long run, earlier firms, existing firms in that market, don't benefit at all from the fact that demand for their products increased. Any benefit that they get is temporary. It occurs in the short run. And provided firms are competitive, we should expect that they might earn positive profits, even large profits in the short run, because firms can't enter and compete those profits away in the short run. But in the long run, they shouldn't be able to earn these profits. And all of those profits that they might get would be temporary. So if you're thinking about whether to invest, say, in a financial asset, in a stock of a company that you think is in a very competitive market, but appears to be highly profitable, think twice. Those profits are probably temporary, and that firm's not likely to be able to continue to earn those profits in the future if that firm is in a competitive market. Now next, past that intuition and that outcome of our model of how competitive markets operate and how firms operate in competitive markets, I want to talk about why it might not always be the case that that long-run market supply curve would be horizontal, because in the case that we looked at, it was. Long-run market supply was constant, had a constant cost, constant price, only at long-run average total cost. Horizontal line. It could slope upward, as with the law of supply, although strictly speaking, the law of supply only indicates that an individual firm would need a higher price to be willing to produce a larger supply, a larger quantity. And that at a market level, the quantity supplied could never decrease as the price were to increase. But there could also be reasons why we might expect at an entire market level that long-run supply could slope upward, that it might require a higher price for firms at a market level to be willing to produce more. Now, if we assume, as we did, that all firms have identical costs, and that nothing about firms' costs change when additional firms enter the market, that's what led us to the assumption that long-run average total cost would remain constant, therefore the supply curve would be constant, would be horizontal, as we increase the number of firms and increase the output we produce. Those two assumptions might not hold in the real world. We could have the first not hold, in which different firms might have different costs, different productivities. Some firms might be managed well, some firms might be managed badly. And if we have exit from the market, logically the first firm to exit would be the least efficient, the firm with the highest costs. And if we have a new firm entering that industry, that firm should already have been in that industry if their costs and their productivity were high, or their costs were low and their productivity was high. Therefore, their profits could be potentially higher than other firms that are already in the industry. If they weren't willing to enter that industry until the price became very high, these are probably inefficient firms. Or they're not willing to produce that product to participate in that market until the price becomes high. Now, we could also have it be the case, not just that firms aren't all equal to one another, so that some are well run and others aren't, but that there are scarce inputs. Things like, say, doctors, which are used by all hospitals. Or things like retail space, which are used by all clothing retailers, space in shopping malls. Now, these inputs, if they're scarce, we could see the price of them driven up when we have entry into the market and more firms competing over those inputs. So more hospitals competing over doctors could drive up the wages that doctors are paid. Or more retailers, more clothing retailers driving up the rental rates for space in shopping malls as more of those retailers enter the market. And if that's the case, then their costs would rise due to entry. More firms enter the market, the higher the costs for all of the existing firms become. And that would be one reason why our long-run supply curve could slope up, become more costly to produce larger quantities because we needed entry into that market to enable us to produce those quantities. So either one is consistent potentially with real-world supply and real-world industries. We could potentially have the assumptions met such that we have a horizontal long-run supply, or it could be the case that we have an upward-sloping long-run supply. And in conclusion, what we've demonstrated here is part of the efficiency of a competitive market and why it is that we think that these markets usually would give us, given these assumptions, given the assumption of competition, would usually give us desirable outcomes, would organize economic activity in a desirable way. First, profit is maximized where marginal cost is equal to marginal revenue, and this is always true, whether we have competition or not. But it's specifically the case that price is equal to marginal revenue, therefore price is equal to marginal cost when firms are profit maximizing, when we have a perfectly competitive market. So when we have a perfectly competitive market and firms are selfish, they simply do what they want to do based on the logic of the market. They're not told what to do by a bureaucrat. Firms will choose to produce up to a quantity where marginal revenue is equal to marginal cost, therefore price is equal to marginal cost. And in the long run, because of entry and exit, seeking profit, not to benefit society, but due to entry into the market to seek profit, that price will naturally also be the same as the minimum of long-run average total cost for the firm, giving us the most efficient possible use of our resources, in addition to allocating the goods to the people who are willing to pay the most for them, and allocating production to those firms that have the lowest costs. We also have all firms producing at a quantity where they are most efficiently using the resources available to them, most efficiently using labor, most efficiently using capital, etc., at the efficient scale. Now, in the next 3 lectures that make up this unit on firm decisions and market structure, we'll move away from this extreme assumption of perfect competition. Extreme assumption of perfect competition, we already mentioned, is not very realistic for the modern economy. Maybe it was 200 years ago, a closer approximation for how real markets worked. Now it's an extreme case that we use to describe what would be best, and then how our real world deviates from what would be best, and what might need to be done to correct problems that are caused by those deviations. In the next chapter, we'll introduce things like monopoly and deadweight loss that arises from market power.